In a previous video, we looked at the fundamental concepts of time value of money. In other words, a dollar tomorrow is worth what today, or a dollar today is worth what tomorrow. In this video, we're going to look at a very practical example, which is mortgages, 30-year mortgages, 15-year mortgages, and what some people do, which is get a 30-year mortgage but pay it down with the higher monthly payment of a 15-year mortgage. And I want to take a look at the calculations there and see how those work out. Let's consider a common scenario. And this is one of those things I end up debating with my coworkers quite a bit and my friends. And I can get into a very lengthy debate. And I bet when you watch this, you might disagree with me, and that's fine. When I bought my first house, I bought two houses in my life. Both I financed with 15-year loans. Use the same realtor for both. And both times the realtor told me, well, of course, you know it's best to get a 30-year loan and pay it off in 15 years. And I was like, no, it's not. And it was like coming out of my skin, like, don't tell me that. It's better to get a 15-year loan and pay it off in 15 years. And here's why. Do you know what interest rates are going to be tomorrow? You probably have a fairly good idea. Do you know what they're going to be in a year? You probably have less of a good idea. Do you know what they're going to be in 15 years? I have no idea. Do you know what they're going to be in 30 years? I have absolutely no idea. The longer the length of the loan, the more risk there is for the lender. And so the longer the length of a loan, typically the higher the rate of interest. With one exception, and that's when there's an inverted yield curve, but that's a completely different story. We'll save for a different topic. So if you look at most interest rates, and right now, I pulled up rates at Union Savings Bank, and this is fairly typical. You see that a 30-year loan is a 7% rate, where a 20 or a 15-year loan is a 6.5% rate. Some banks will offer a 10% loan at an even lesser rate. The reason for the difference in the rates is the risk that comes with that unpredictability between years 16 and 30. So if you do get a 30-year loan, you're going to be paying a higher rate of interest. And if you get a 30-year loan, if you get a 15-year loan, you're going to get a lower rate of interest, but the payments are going to be higher because you're paying that loan back sooner. Now, the question is, and this gets back to when I bought the house, what if you get a 30-year loan with a higher rate, but you pay the 15-year payment as though you had a 15-year loan? When would that loan get paid off? Or in other words, you got a 30-year loan with a higher rate, but you paid the 15-year higher payment on it. At the end of 15 years, would that 30-year loan be paid off? And the answer is no. Now, the real question is, what's the difference? In other words, what would it cost you to get the higher rate of a 30-year loan, but still make the higher 15-year payments? At the end of 15 years, what would that cost you? And this is something we're like, oh, I have no idea. You start to think present value, like, all right, I'm lost now. Don't worry, this is a calculation we can do in just a few lines in Excel. Well, just as we can compute present value and future value in Excel, but I didn't show future value, but by the way, just FV is the formula for that, which I'll use in just a second. Just as the way I can do that, I can also compute the payment on a loan, the monthly payment. And for that, we simply say PMT. And then we give it a rate. Well, we're going to assume monthly compounding, and I'm saying a 6.5% interest loan for a 15-year loan. Because it's monthly compounding, I'm going to divide by 12. Now, the number of periods, it's a 15-year loan, but we're going to say monthly payments again, so I'm going to say 15 times 12. So you see, we have the 12 on both sides of the equation. Divide the interest rate by 12, but then multiply the years by 12, and that ends up equaling out. Next, we have the loan amount. Let's say this is a $100,000 loan. So if I count my zeros there, it should be about right. Yeah. So basically, if you have a $100,000 loan at 15 years, monthly payments, 6.5% interest, your monthly payment will be $871.11. On a home mortgage, you typically also have insurance and property tax and a few other things, but just the loan and the rate is going to look like this. Now, let's take a look at the 30-year option. So payment again, and rate of 7%, because remember that 30-year loan, there's more risk to the bank, so they're going to charge a higher rate. 12 payments a year, so divided by 12. Then a 30-year loan times 12 payments in a year, one per month. And we're going to say this loan is for $100,000. And you notice that the 30-year mortgage is $665, where the 15-year mortgage is $871 per month. This is where a lot of people stop and say, I'll take the lower payment. And, and then they think, well, but hey, I don't know if I want a 30-year loan. Oh, okay. I'll take that lower payment as my loan term just for security. So I know that it worst case, I owe that lower amount. But I'll go ahead and pay that 15-year payment anyway while I can afford it, and I'll pay the loan down early. So what's the cost of that? This is a bit of a trickier formula, but it does let us use one of the time value of money formulas we've not used yet, and that's future value. So let's say future value. Now let's do the rate. Remember, it's a 30-year loan, so we're going to say 7% divided by 12 because we have monthly payments. Number of periods. Okay, so we're going to go ahead and say 15 periods times 12 because we're going to say we're going to go ahead and make payments as if it's a 15-year loan at the 15-year rate. The question is, how much loan is left after 15 years? So we just apply the 15-year payment. Again, remember, on a 30-year loan, we're applying that 15-year payment. And then present value, see there's a little PV that's kind of in bold now. That's effectively the loan amount, which is $100,000. So let's see, if I take out a 30-year loan at a 30-year interest rate, but I make 15-year payment amounts on it, how much is left on that loan at the end of 15 years? And the answer is $8,768.48. Those signs look funny. It's really a positive amount. I could fiddle with these numbers a bit if that looks better. That's what's left on the loan. So that's the cost of that extra 0.5% interest rate for the higher risk of a longer duration loan. And you see, after 15 years of payments at $871.11, you still have a balance of $8,786.48, which is about an extra year's worth of payments. So that's effectively the cost of that extra interest rate that you're paying for a longer loan. Now, I know that was a lot of trickiness. Let's just validate my formula. I'm going to run the same formula, but instead of the 7% rate for a 30-year loan, I'm going to run that again as a 6.5% rate we have on the 15-year loan. I don't expect it. It should be pretty darn close to zero. It might not be exactly zero, but it should be within about $1 or so if my formula is correct. And sure enough, formula is correct. So you notice 30-year loan, 7% paid off in the 15-year payments would take about 16 years to pay off. But a 15-year loan with a 15-year rate in 15 years worth of payments means at that end of 15 years, we end up with a zero balance. So that $8,786.48 is the extra interest you're paying for that 0.5% over that time. Now, as I said, this is something it's kind of one of those things I enjoy talking about and getting into a very intense debate about. And there are different ways you can look at this. A lot of times the people who like the 30-year loan say, well, I like that flexibility of having a lower payment if I need to drop down for some reason, if I become unemployed or something like that. Certainly there's merit to that argument. There is a little safety net to that. The question is that safety net worth, in this case, about $8,700 on a $100,000 loan. Keep in mind, if that were $500,000 loan on a McMansion, that would be a much higher amount that you're talking about. Now, the other consideration is there any other place you could tap for emergency money if you were temporarily unemployed? Well, savings is always a good idea. And you see, if you have savings, then you can fall back on this 15-year mortgage and you end up with more savings in 15 years. If you don't have savings and you go with a 30-year route but make the higher payment, well, then you're kind of cheating yourself out of that money, and then you have less savings at the end. So that's one thing to keep in mind. Another thing to keep in mind is that with a 15-year loan, you're paying off your house much sooner. And what that means is you have more home equity. And what that means is you could take out a home equity line of credit if you were temporarily unemployed and needed access to that cash. So that effectively the difference in the 15 to 30-year payment, a lot of that's going to pay down your mortgage early anyway, pay it down sooner, which makes that equity available to come out in a home equity loan. So a couple things to think there. I'll give you another scenario that I had, real life scenario. The second house I bought, I took out a 15-year loan, and I found a loan agent who would refinance me at no cost anytime I wanted. And so anytime rates dropped by a quarter point, I'd call him, he'd come over with paperwork, I'd refinance my loan. I ended up refinancing that house 7 times in 2 years until I got it to a rate of 2 5/8%. And each time I met with the loan officer, he told me, you know, the smart thing to do, even though you're starting a new 15-year loan, the smart thing to do is go ahead and end that when your original mortgage would have ended. And I said, absolutely not, because the home mortgage, my last rate was 2 5/8%, which was very low. And I said, I want to borrow at 2 5/8% as long as I can. I am in no hurry to pay this down. And not to mention, depending on income and several other things, that's a tax deductible 2 5/8%. Okay, well, over the life of that loan, you know, I refinanced as it got lower, and then interest rates went up, but my rate was locked in. As interest rates went up, you could invest in a very safe investment like U.S. Treasuries that started to pay more than 2.58%. So borrowing at this amount and then lending at a higher amount made more sense to do that than to pay off the mortgage early. You know, that was kind of free money for a while. So a lot of different conversations we can have here, a lot of different things, but I like this example because I think it's a prime example of the time value of money formulas that are very important. We're looking at present value, we're looking at payment, and we're looking at future value, and we can actually quantify that cost of taking a higher risk loan with higher rate and paying it off sooner versus just taking out a loan for that a loan with less risk because it's a shorter loan and paying it off at its normal duration. So, as I said, you're welcome to disagree with me. I love a good discussion, and I'd love to hear what you have to say. Let me know what you think. Thank you.